Hey guys, good morning. This is Criss, and welcome to your mortgage rate forecast for September 6th. So here's what we have. If you look at my screen, since the last report, the Mortgage Bankers Association has reported the average 30-year fix to actually go down 0.01% to 4.8%. So not a lot of movement as far as mortgages being completed. But where are rates going? That's the big question right now, right? So if we take a look at the technicals, here's what we have. September 4th and August 28th, I'll show you the charts in just a second. Those were pretty big days, and it was a lot to do with the negotiations on tariffs with Canada. That caused some pretty good movement in the bond market, I should say. Bad movement in the bond market. As far as today goes, we did get some gains back, some of those losses back. The ADP report was soft, factory orders, labor costs, blah, 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 blah. But one notable thing is the jobless claims are down to their lowest point since 1969. So that means employers are holding on to their employees longer. And that also means that maybe there's, it kind of puts hiring rates into question. We'll put it that way. So let's get to the technicals real quick. Here's what we have. As you can see, since my last report, bonds have sold off, pretty hard. That was kind of expected. Today's a pretty good day. But I don't think we're gonna see this for long. And I'm not trying to be pessimistic here, but you can see if you look at my mouse, we are starting to develop a downward trading channel. And with that downward trading channel, it's really hard sometimes to break out of that and trade higher. And we want bonds as consumers to be trading higher because that means lower rates, lower fees for us in the long run. So where do the analysts stand? Well, the analysts are pretty mixed on the short term. Some analysts are pretty concerned about the reports that are coming out tomorrow, and they're saying, hey, we should lock in. We should be safe, lock in the interest rates because we think interest rates or the market is going to get worse. Other analysts are kind of neutral, but I don't see any analysts that are saying, hey, let's go for this. I think we're going to, bonds are going to trade really, really well and bring with it lower rates. So I think for right now, be careful, maybe steer to the side of caution and consider, locking in. Here's my forecast for the next 2 weeks. Bonds are currently trading at 101.76. I think we could get better by maybe 15 hundredths of a point, 14 hundredths of a point, not much, but I think we can get worse by almost half of a point. So that means if we float, if my predictions are accurate, I think there's more room for things to get worse before they get better, unfortunately, in this market right now. So I would say if you are floating alone right now, probably want to be pretty careful. Anyway, that's it for this week. We'll see you in a couple weeks. Please leave those comments down below. We'd love to hear from you guys. If you have any questions, we respond to all of our questions. And so anyway, that's it for now. We'll see you in a couple weeks. Take care, guys. Bye-bye.